Well, thanks so much for tuning into this earnings conversation with Titan and the management, Johnson, to talk about how the quarter was. More importantly, um, I think the con call had the color of how demand in January is looking okay. So are things looking normal, if I can use that term for Titan? Mr. Venkataraman, Johnson, for that. So thanks so much for joining in. Put the quarter into perspective. I mean, it largely stayed on expected lines. Maybe you would argue that a couple of soft spots, but you reckon that that might get corrected in the quarter ahead?
Yeah, if you recollect, the retail sales growth that we spoke about and shared in quarter 3 was quite consistent compared to the earlier periods, as well as even within the quarter. It was not as if the October month was heavily loaded and, then we had a declining growth rate or something like that. It was pretty reasonably consistent through the quarter. It is just that because of this buying and selling of one channel, which is a significant channel in the jewelry business, the primary sales growth was a little lower. That's all. Otherwise, we have been normal for a reasonably long time now, Neeraj, and continue to be so. January was good, continuing to be on growth track, on the same trajectory. Overall sentiment of the kind of customers that Titan Company caters to continues to be positive. So all good overall.
There's this belief that the conversation around urban discretionary demand or urban demand coming down is more urban demand returning to trend as opposed to really falling off, because urban demand had really gone up. Now, just give us your perspective of how are you seeing one, the urban demand, and two, to an extent, whatever insights you might have on rural, because again, the feeling is that since January, that has started to come back. Is that making any meaningful impact on your performance?
So we are not a particularly large, rural company, even though we are now starting to get some kind of rural share as we move into smaller and smaller towns. But
okay, let me divide it into metro versus non-metro. Sorry.
So non-metros, continue to be having a very large opportunity, particularly from a distribution expansion potential point of view. And we are, clearly our, foot on the pedal on that pedal is quite pressed to keep opening more and more stores in the smallest of towns in the country. And see, the challenge, Neeraj, is it's not very difficult to get a macro view of urban discretionary demand like that, because you get pieces of performance of different companies and you hear and you add them all up. In that sense, it's a macro aggregate view. But what also happens is, depending on which part of the income pyramid each company is sitting, how strong the brands of that company are, what kind of innovation that company is all the time doing, what kind of loyalty programs, customer connections. Like I spoke yesterday about 20 million plus loyalty customers about whom we understand a lot. And we have relationships between our sales staff of close to 20,000 sales staff in touch with millions of customers. And therefore, I just said a sale is just a phone call away, just to illustrate the power of that relationship. Therefore, a company like Titan, and the huge upside sitting for a company like Titan in the acceleration of formalizing. Whereas some other companies which may be in the discretionary space, where the category is already formalized, and therefore the market share gain opportunity is low. So that company may find it, like even if I were to distinguish between a Titan, the watch business of Titan has got a very high market share. The jewelry business of Titan has got a very low market share. So intrinsically, the formalization opportunity is greater for jewelry, less for watches. But the innovation that Titan brand of watches is doing and continue to do can still buck that disadvantage to some extent. Whereas Tanishq will have formalization advantage, meaning market share gain, headroom advantage, as well as the innovation that it is doing. So that's the way a company with these advantages and these capabilities can do better than the discretionary sector as a whole. So it'll be difficult to, because there is no published information which says these types of income segment people, what is their mood, what are they saying about what they will buy in the next few months. We are all conjecturing or sort of adding results, conversations of various heads maybe, and putting all that together and saying. So that's the nature of this situation. I don't think we can get better than that. But yeah.
Got it. So difficult to give very conclusive or informed guesses, if you will.
At the macro level. But I'm saying that our confidence is based on some of these factors which are unique to us.
Yeah, and intrinsic and probably work for you every quarter. So in that sense, it's fine. Okay, let me try and ask you another thing. So yesterday, a very noted economist told us about how after a year and a half or 2 years of the informal sector lying low, finally they might be able to come back in 2023. It's for the first time that I heard you guys talk about competitive intensity the way you did put out those statements. So my question is therefore, how high is the competitive intensity? And do you reckon that in some fashion, informal sector, which is such an integral part of the jewelry business, might kind of make its presence really felt in 2023, sir?
Actually, what we have seen is over the last few years is a strengthening of local brands, right. Jewelry brands across the country in maybe 20, 30 towns, cities and towns. I wouldn't call that the informal sector. They are actually very, very well organized jewelry companies. Maybe only one store in a one situation, maybe a few stores in another situation, etc. But they are pretty formal. But therefore, let's say they would represent a kind of choice for the customers of Tanishq in those cities. I'm saying a kind of choice because it's not entirely a full choice. There are many people who buy Tanishq to whom that jeweler would not be a choice. But to some customers of Tanishq, that would be a choice. So in that sense, that competitive intensity has risen because those jewelers have become better organized. They've seen the opportunities in, for example, diamond jewelry, other differentiated jewelry for profits. They have set up better stores, improved their customer experience, and so on. But at the same time, they represent not a very large share of the market in that city. There are lots of other jewelers who are part of what you could call the informal jewelry industry who have been under pressure for a while now, starting with the demon, then GST, then hallmarking, then COVID-related supply chain, as well as, banking, finance restrictions. So the market share growth opportunity is actually a lot coming from that little bit of implosion, if I can call it. I mean, implosion may be too strong a word, but you know what I mean. Slacking in, the supply side of that, which may be 60-70% of that town. This jeweler who I'm referring to, maybe 10%. So that 10% has become strong, but the 60-70 continues to be weak. And notwithstanding the person's comment yesterday continues to be weak because COVID has also opened up people's sort of consciousness about what is authentic, what is important, not just in relationships, but in life in general. Plus the Tata name during the last 3 years has become so powerful. And in the smallest of places you can go to in India with the Tata name and Tanishq from Tata.
Certainly. Most certainly. Well, a Tata coffee stall in Davos really attracted so much of attention. So, the brand carries the kind of power that it does. My final question, Mr. Sir, is on operational metrics. Now, you guided to that standard 12-13%, but you've spoken about competitive intensity. Could it be a steady state linear 12-13% management quarter after quarter? Or could there be some disruptions in a quarter, but on an annual basis, you will be in that range? How would it work? Just trying to understand so that next time, if there is a drop, I do not ask you a question because the annualized numbers might still be 12-13%.
See, if you look at the overall financial performance of Titan Company, and if you look at the EBIT margin as one of that metrics, and if you look at the capital turn as another metric, we are a very, very good, well-performing, financially well-performing company with a long runway for growth. And therefore, our conversation and this is not just now, for many, many years now, and our response rather to this particular point has been that we will continue to grow. And our emphasis will be rather more on growth and less on profit expansion. And there was a specific question you may, if you were watching yesterday, about an earlier comment we had made some years back about if you grow 20%, it would be unlikely that profit expansion will not happen and all that, that our earlier CFO had said, and that question was asked in that context. And I clarified saying that, in those times, the competitive situation was certainly less for the jewelry industry. And even in eye care, for example, compared to today versus then and all that. And those days, if we grew 20% in sales, most likely we were growing somewhat similar in gross margin in rupees, and therefore the leverage opportunities were sitting. Whereas today, if you're growing at that rate, we could end up, I'm saying could end up compromising gross margin a little bit, and therefore the expansion opportunities which are there in scale may not kick in, and therefore we may end up at the same level of EBIT margin as before the period began. So to that extent, it is more difficult to predict and sort of confirm. And that's why our indication is that we'll continue to remain at this level of profitability, but certainly surging as far as growth is concerned.
Got it. We are out of time. I haven't been able to ask you about the one standout feature for the quarter, but maybe I'll save it for the next time, sir. But I understand you have a busy day, so we'll let you go. Thank you so much for taking the time out, and have a great 2023.
Thank you, Neeraj. Bye-bye.
The pleasure is ours. Viewers, thanks for tuning in.